Hi everyone, I'm Sudhir Holla, founder and CEO of myStockDNA, and this episode is a special one. I'm joined by someone I've worked closely with over the years, someone whose academic brilliance helped shape the way we think about portfolio construction, Professor Kumar Muthuraman. But before we dive in, let me set the stage with a little story that sums up the heart of what we do. An academic, a technologist, and a chimp walk into a bar. The bartender looks up and says, "Is this a joke or some kind of quant-off?" Turns out it's both. We each grab a set of darts and head to the board. The academic, that's Kumar, starts crunching numbers on the optimal trajectory and referencing bounded noise portfolio optimization between throws. I'm the technologist. I've built an AI that adjusts in real time, learning from every throw, optimizing for precision. And the chimp, no theory, no tech. Just a well trained routine, same throw every time, no ego, no tweaks, just process and discipline. And guess what? He's the one who wins. That's the heart of Moneyball investing. Winning not by being the flashiest or the most complex, but by managing risk, following a system, and staying consistent. Now, back to our guest. Kumar is the director of the Center for Analytics and Transformative Technologies at UT Austin. He's also our co founder at myStockDNA and someone who brings a much needed academic lens to how we think about markets. Kumar, great to have you here. Can you tell us a bit about what you've been working on lately?
Yes, hi Sudhir, thanks. Hi everyone. It's great to be joining you all. As Sudhir mentioned, I'm a faculty at the McCollum School of Business. I'm very interested in portfolio optimization in general. My thesis back when I did my PhD at Stanford was on computational portfolio optimization, and I still have a huge interest in getting this nailed down. And as we all know, it's far from being a solved problem. Essentially, I'm very interested in figuring out why quant works and why quant fails in the case of portfolio optimization and how we can do this better. And several of my research papers are along those lines in terms of how estimates or assumptions that we make kind of help us or more specifically hurt us sometimes when we try to manage portfolios. So that's still at the heart of what I do, and that's still the reason why I'm very interested in my startup DNA, and I enjoy working with Sudhir on these things.
Before we move on, we have to make a quick stop. It's time for the legally required disclaimer. This is your cue to pause the video or audio if you need to review the disclaimer in detail. There are 4 sections in this video, and they've been stitched together from various podcasts that have been recorded over the past few months. So in true Gen Z fashion, we'll be reacting to our own content, except this time with Kumar bringing in the academic lens to everything we discuss. We'll kick things off by walking through the year-to-date performance of our portfolios, which we are happy to say have navigated this year quite well. Then we'll shift gears to the broader market, what we're seeing, what economic regime we think we're in, and what might be coming next. After that, we'll break down how the UMI portfolios are constructed using a simple example to walk you through the logic behind the models. And finally, we'll dive into a topic that's a bit unusual for quant and tech geeks like us: emotions. Turns out managing client emotions can be just as critical as managing the portfolio itself. Let's talk performance, and more importantly, performance relative to risk. What you're looking at here is a 5-year view of the UMI portfolios. From top to bottom, these portfolios range from conservative to aggressive. And what's fascinating is how cleanly they demonstrate the trade-off between return and downside risk. Take the UMI conservative portfolio. It delivered a 9.5% annualized return with a down capture of just 10.8%. That means if the market dropped 50%, you'd expect this portfolio to drop around 5%, a tenth of the drawdown. That's impressive protection. Now contrast that with the UMI growth portfolio. Nearly 20% annualized return over 5 years with a down capture of just over 31%, still well below the market's 100%. And then there's the UMI aggressive with leveraged ETFs coming in at over 2% annualized return. Yes, the down capture increases to about 42%, but you're still getting a much better return for each unit of downside risk compared to the market. For reference, the S&P 500 delivered 18.5% over the same period, but with a full 100% down capture. So UMI isn't just about chasing higher returns, it's about optimizing how much downside you take on to get those returns. So here's how the UMI portfolios have performed so far in 2025. As of April 10th, the S&P 500 is down over 10% with a drop of around 20% from its peak. a pretty sharp correction. But look at the spread in the UMI portfolios. The conservative portfolio is virtually flat at just 0.2%. That's what a well cushioned, low volatility ride looks like. Now, the growth portfolio without leveraged ETFs is down about 4.8%, which is still less than half the drawdown of the market. The rest fall in between with a clear, consistent pattern. More return potential comes with more movement, but even the most aggressive UMI portfolio with leverage is still outperforming the S&P 500 on downside protection. Think of the conservative portfolio like a kiddie roller coaster, smooth, steady, and easy on the nerves. The growth portfolios, they're adult roller coasters. A few more twists and turns, but still far less dramatic than the market's plunge this year. This is where risk management kicks in, not just to protect capital, but to protect peace of mind. This next section is pulled from a podcast we recorded at the end of February. In it, we talk through what we believed was the state of the market at the time, based on how Darwin, our machine learning powered investment coach, was adjusting allocations. We dive into some economic theory, layer in a bit of quant modeling, and true to form, mix in an analogy or two to keep it engaging. Let's jump in.
For those who haven't heard this analogy before, explain it to us. Why do you compare investing to running on a mountain trail?
Think about it like this: if you're running up and down a hill, your biggest challenge isn't just the uphill climb, it's avoiding ditches along the way. If you trip and fall into one, you have to spend way more energy climbing back out. That's exactly what happens in the stock market. If your portfolio takes a deep dive, you're not just losing money, you're losing time. And time is your most valuable asset in investing.
So the key is avoiding major losses, rather than just chasing big gains?
Exactly. The goal isn't to never experience volatility, that's impossible. The goal is to minimize the damage when markets turn rough so you recover faster. Now, let's talk about the two types of runners on this trail because they represent two types of investors. First, you have the aggressive, brave runner. This is the investor who sprints ahead, taking higher risks in search of the fastest way to the top. They invest in high growth stocks, leverage, and momentum plays. When the trail is smooth, they look like champions. But when the terrain shifts, steep declines, unexpected ditches, they may risk falls that take time to recover from. Then there's the defensive, cautious runner. Right? So this investor is measured, focused on consistency rather than speed. They take calculated steps, allocating more to stable investments like bonds, gold, and defensive stocks. They won't get to the top as fast in a bull market, but when conditions get rough, they stay on their feet and avoid the worst drops.
So both types of runners are trying to reach the same goal, but their approach is different?
Exactly. The UMI conservative model is represented by the defensive cautious runner, and the UMI growth model is represented by the aggressive brave runner. Both react differently, and both approaches are valid depending on how you emotionally react to risk. Right now, investors are asking, is this just a minor dip or is something bigger happening? In our framework, we call this assessing whether the market is just tired or having a heart attack.
All right, let's get into that. What does it mean when you say the market is having a heart attack?
This is a concept we've discussed before in a previous podcast, but it's worth revisiting, especially given the current market environment. Not every downturn is the same. Sometimes the market just needs to catch its breath, a temporary pullback before continuing higher. But other times it's a deeper structural issue, which means more prolonged pain. This slide, which we've used before, lays out the different economic regimes and how various assets behave in each scenario. The key to understanding what's happening right now is recognizing how money moves depending on the environment.
And where does money go when markets drop?
That depends on the type of downturn we're experiencing. Money follows predictable patterns, flowing into different asset classes based on economic conditions. The three major destinations are stocks, bonds, and gold, and their performance is dictated by whether we're in a period of inflation, deflation, economic expansion, or contraction. Stocks perform well when the economy is strong and growing because corporate earnings are rising. Bonds act as a hedge in deflationary or slowing economic environments, offering stability when interest rates fall. Gold becomes a preferred hedge during periods of high inflation or economic uncertainty when investors seek safety outside of traditional financial assets. Right now, the market is adjusting, and we're seeing shifts in these money flows. That's why it's crucial to identify what kind of economic regime we're transitioning into, because that will shape investment strategy moving forward.
So if we assume the market is having a heart attack, how do we figure out if it's a mild one or something more serious?
Actually, it's not about intensity. A market downturn, no matter what kind, is always bad if you're not prepared for it. The key isn't determining how bad the situation is, but what kind of downturn we're dealing with. We categorize market heart attacks into two distinct types based on the economic regime. In type A, we're dealing with a deflationary slowdown, a scenario where the Federal Reserve's interest rate hikes successfully slow the economy, inflation cools, and government spending is kept in check. It's still a painful environment, but the impact is more about economic stagnation rather than runaway price increases. In type B, we have an inflationary crisis where inflation doesn't go away, supply chain pressures persist, or tariffs push costs higher globally. Here, the challenge is different, but not just slowing growth, but rising costs that eat into corporate profits and consumer spending power.
So both scenarios are bad. But what changes is how you protect your portfolio.
Exactly. In type A, the focus is on holding more bonds and defensive assets, since interest rates are stabilizing and economic activity is slowing. In type B, traditional hedges like bonds might not work as well, and you'd want more exposure to commodities, real assets, and inflation resistant investments like gold. Right now, we're evaluating which type of scenario we're heading into. The good news, it's too early to assume the worst. The key is being prepared for both possibilities and positioning portfolios accordingly. This slide is from our most recent podcast. In the previous one, we talked about the rising risk of a heart attack in the markets. Darwin was signaling stress, but we weren't yet clear on the type of heart attack we were facing. Fast forward to this update, and the picture is clearer. Darwin's latest allocations point to a much higher probability of a type B scenario, a stagflationary environment with inflation staying sticky, even as economic growth softens. Kumar, you and I have joked about this before. The cholesterol's been building up for a while now. From an academic standpoint, how would you frame what we're seeing here?
Hi, Sudeep. Thanks. So I want to emphasize on what you mentioned just a minute ago. You said the probabilities have shifted, and that's the key. In some sense, the analogy of a heart attack helps, but we also want to be conscious that we're not always trying to predict a heart attack or a disease. It's more the situation of continuous monitoring. It's not like we're trying to predict an earthquake and then react to it, right? It's happening every day. Financial markets are trading every day, and things are shifting under our feet as we speak and as we trade. And therefore, it's extremely important for us to realize that we're not trying to figure out, for example, in this case, which of the four buckets we are in. We're always trying to figure out what is the probability that we are in each of these buckets. And the sense of probability is very helpful because it allows us to be wrong and not get too hurt if we are wrong, right? And again and again, legendary investors will tell you that the worst thing in financial markets is overconfidence. And overconfidence would be similar to saying, hey, which of the four buckets am I on? Am I confident about it? No. If we say instead, hey, there's a 70% chance we are in this bucket and a 10%, 10%, and another 10% on the other three buckets, that allows us to take advantage of shifting behavior. At the same time, it allows us not to be hurt by something we might have not to be hurt by a small mistake. And I want to emphasize that particular thing about allowing ourselves to shift smoothly between our beliefs as the markets reveal themselves more and more.
Yeah, it kind of makes sense in other ways as well, right? So if you look at it like a patient, right? The way I see the deficits in the economy or the tariffs are coming up, it's essentially symptoms, right? So if you put an indicator on the patient, you're seeing that a lot of the indicators are flashing orange or flashing red. Now, when exactly the patient collapses, that's what we are trying to predict the probability of, correct?
Right. Not even the patient collapse. That is some sense okay, but it's always the case about, there is no end, right? We are always going to be trading and we're going to keep at this portfolio. It's not like we want to predict towards a specific event. A specific event sometimes hurts, sometimes you have to be cautious of interpreting. It's more like continuously monitoring your cholesterol, and if your cholesterol goes too up, that kind of increases in your brain the probability of a heart attack, and therefore you start eating healthier.
Yeah,
that
makes
kind
sense.
of an adjustment, right? It's smoother dynamic adjustments. You don't want to suddenly exercise for 10 days and not exercise for another 10. That's not a good, that's allowing the volatility of the market to enter straightforward in as a volatility into your portfolio, or even more amplified in your portfolio. What we want to do is the other way around. there is volatility in the market, and the hope is that our portfolio is much smoother. Going back to your analogy, yes, the market is going down into a ditch and then climbing itself out back, and we don't want to do that. We want to decrease and we want to smoothen our transitions in our portfolio and not reflect the market exactly.
Yeah, makes sense. Thanks.
For advisors who are newer to us, this slide introduces the core philosophies behind Darwin, our investment co-pilot. The first principle is something we really believe in: winning by not losing. It's a mindset borrowed from Moneyball. And as we said earlier, if you don't fall into the ditch, you don't have to waste time and energy climbing out. The idea is simple: protect capital first, and compounding will take care of the rest. The second principle is about following the money. Markets operate in different economic regimes, and money moves differently through each one. Darwin's job is to detect those shifts and adjust the portfolio accordingly. We touched on this earlier when we talked about market regimes and heart attacks. It's all part of the same framework. And the last principle is a nod to humility. No strategy is good forever. Markets change. So while predicting matters, reacting when your prediction is wrong matters even more. Darwin is built not just to make intelligent predictions, but to course correct quickly when the data says it's time to pivot. This next segment is from a podcast we recorded back in January, where we dug into how the UMI portfolios are actually constructed. We used one of our core strategies, the defensive ETFs and stocks rotator, as the example to explain it. Think of this strategy as one of the players constantly competing for allocation across all UMI portfolios.
Today, we're putting the spotlight on one of the key strategies in the UMI portfolio, the defensive ETFs and stocks rotator. And along the way, we'll take a deep dive into how Darwin assembles strategies into a portfolio, kind of like drafting the perfect sports team.
Every strategy has a role, just like every player on a team. Some are scorers, some are defenders. And today's MVP, the defensive squad, the defensive ETFs and stock strategy.
Before we talk about the specifics of this strategy, let's take a quick refresher. Last month, we walked through how strategies compete for allocation in the UMAI portfolio. Think of it as an intense training camp. Only the best strategies get picked to play.
Exactly. Each strategy is genetically engineered to be aggressive, market neutral, or defensive. And within each strategy, stocks and ETFs battle it out to secure their spot. It's survival of the fittest, but for investing. Let's also talk team building. Every great team has a mix of high scorers, playmakers, and strong defenders. If the growth-focused strategies are the strikers, the defensive ETFs and stocks are the goalkeepers, keeping us from getting scored on when the market turns ugly.
That's a great analogy. This strategy is all about reducing risk and stabilizing the portfolio. It's the equivalent of having a rock-solid defense that ensures you don't lose big, even when the market is throwing curveballs.
Now this is where things get really interesting. If we treat each month like a game, how often does this strategy actually beat the market?
You'd think it wins most of the time, right? Well, it actually loses more than it wins. 110 wins versus 130 losses. The graph in this slide visualizes this by mapping the strategy's returns against the S&P 500's returns. The y-axis represents the strategy's returns, while the x-axis represents the market's returns.
Wait, what? It beats the market overall but still loses more often?
Yep. The key is in how it performs under different market conditions. The slide highlights 4 key quadrants: greed, where the market is up, but the strategy lags; ecstatic, where the market drops, but the strategy rises; fear, where both drop together; and happy, where both rise together. This strategy thrives in the fear quadrant, meaning it steps up when the market is struggling, protecting the portfolio.
That makes sense. It wins by not losing big. When the market crashes, this strategy steps up big time. But when the market is booming, it lags. That's why it struggles in greed phases but dominates in fear phases.
Let us take a break here and revisit this slide presented in the podcast with the context of recent data, because it helps explain how the UMI portfolios are actually built, especially in light of recent market performance. Now, while we often talk about ETFs, think of the UMI portfolios as being built using synthetic ETFs instead of off-the-shelf ETFs. Think of each of our strategies as a synthetic ETF built with its own quant brain, its own playbook, assumptions, and strengths. Each of these strategies is like a player on a sports team competing for a spot in the portfolio's starting lineup. On this chart, the y-axis shows how much each strategy contributes to returns, and the x-axis shows how much it helps reduce risk. The top right quadrant, that's where your MVPs are, strategies that are pulling their weight on both offense and defense. Take the defensive ETFs and stocks rotator strategy we just talked about. And it had a steady season in 2024, but in 2025, it's really stepped up, playing solid defense when the market got shaky. That's exactly what it was built for. The crypto strategy, it was the star striker in 2024, delivering huge returns, but it's been on the bench a bit more in 2025, down slightly this year. And then there's the aggressive FNGU strategy, swinging for the fences with a 27% drop in 2025. High reward players come with high volatility. It's part of the game. Now, depending on the portfolio's risk tolerance, Darwin, the coach, allocates differently. Conservative portfolios field more defensive players, while growth portfolios give more minutes to the aggressive scorers. It's all about building the right mix for the game you're playing. Kumar, you shared some really insightful thoughts here, especially around the use of quant models, the assumptions that often get ignored, and your perspective on models like the Markowitz efficient frontier. Would love for you to revisit some of that academic context for our audience.
Thank you, Sudhir. This is what we're talking about right now is extremely close to my heart in terms of what I do for research and I think a lot about. Now, the issue is that when we do quant, right, we confuse two things. We have a quantitative model and then we do have assumptions. And often when we come up with a prediction mechanism or a prediction tool or any kind of quantitative engine, both assumptions that we had and the quantitative methods that we slap on top of the assumptions together function as traders or predictors in future markets. And more often than not, people who do the quant forget how important or how critical their assumptions were. And assumptions that go into a quant model are a variety, very many are strong assumptions. You could have assumptions on what I believe. I believe the last 5 years of the market is very similar to the next 1 year. You might believe that the last 20 years is very similar to the next 5 years. You know, all kinds of assumptions on timelines, assumptions on which stocks or which parameters affect which other parameters, what kind of model do they affect each other through a linear model or something more complicated? You know, how stable or how dynamic are these? We make a ton of assumptions. And after these assumptions, and we should all say this out loud, we don't do this often enough. The moment you touch historic data, it doesn't matter what the context is. If you touch historic data, you are making the fundamental assumption that the past is a good predictor of the future, right? So which part of the past, which part of the future, all of those assumptions. Once we do all these assumptions, we slap math or quant on top of it, and the math is always correct, right? The math is always correct. Assumptions might not be. The math is always correct. If 2 plus 2 is always equal to 4, right? So when you have a screen of this kind and you have various dots indicating various portfolios and their performances, each dot being articulated by one particular model and its performance, what is changing is the math is consistent. In every one of these dots, the math essentially is 2 plus 2 equals 4. There isn't a portfolio where we assume that 2 plus 2 equals 5, right? The math is always consistent. What is different from each of those is the assumptions that went into play, right? So we make assumptions on asset performance. We make assumptions on what if the market does this, which assets are more likely to do better and things like that. So we are a little hedgy in terms of each of the portfolios and, which of these portfolios will perform in which kind of a market. But we are very conscious that if we put all our money into one of these portfolios, that would be overconfidence, and that would be overconfidence in the assumptions, not the model, the assumptions. Now, the problem with quantitative people is that they would make some assumptions, they would come up with sophisticated math, and they would come up with a portfolio or a trading strategy. Then that trading strategy doesn't do well. You know what most people say? They say, oh my God, the market did not align with my model assumptions. That's a wrong way of obviously looking at it. It's your assumptions that didn't align with the market. It's not like the market did anything different from, just because the market did something that you did not predict it, it's not the market's fault. It's our fault in being overconfident with our assumptions. So essentially what we are doing here, the way I'd like to look at what we're doing here is we're building all these different portfolios under various different assumptions and fluidly and more smoothly moving our money between these portfolios to essentially tell ourselves, hey, we don't want to be overconfident in our assumptions, but we definitely are confident enough about them not working, just not overconfident about the assumptions. That's the way I'd like to think about what we're doing. That way we have the ability to not get hurt too much for one wrong assumption or one wrong modeling behavior.
Yeah, I would agree with that. In fact, would you care to kind of repeat the point that you made about the Markowitz, especially in 2022, for example, right? Because what I find through various conversations is that a large portion of the broker-dealer network and the still rely extensively on the stocks bonds negative correlation, and have continued to construct portfolios. They did so in 2022 and are probably going to continue because that worked since the 1980s onwards. Now you had a point saying that, look, the Markowitz efficient frontier is not wrong, but the kind of the assumptions that play, and that's certainly part of your paper on the bounded noise optimization as well, right?
Exactly. You've touched upon my bounded noise paper, and this is again, right, this is a big deal. In Markowitz, when he wrote his paper, that's the Nobel Prize winning paper, he was very, very clear. He's making some assumptions, arguably very strong assumptions, and these assumptions included things like, hey, the market can be well captured, the performance of the past market can be literally captured pretty much by a covariance matrix, right? How did all the stocks vary with respect to each other? And he was going to assume that for the next time period, whatever the time period is, month or year, that we're going to hold the portfolio for, this covariance matrix is God-given for the next time period, right? And that God-given, the fact that the portfolio, the covariance matrix does not change is a God-given assumption, if you would, but it's, we know what the covariance matrix is, and then you build your portfolio on top of it. The problem is that you're doing two different things. You're doing estimation, and the estimators do understand that they could be wrong, and they're trying to do their best. That's the estimators of whatever parameters. But then the estimators hand over their estimated parameters, in this case the covariance matrix, to portfolio optimizers, and the portfolio optimizers essentially think of the estimators as God, and whatever they give as God-given, and that's the scary part, right? If you tell me that I'm going to sell 100 cups of coffee tomorrow for sure, right? I'm going to only have inventory for 100 cups of coffee, right? Not 101, not 99. But if you tell me, hey, I expect you to sell 100 cups of coffee, but I might be wrong, then I will hedge my inventory, right? And that's the problem. The problem with Markowitz's classical methodology is the covariance matrix is taken as God-given. So the portfolio optimization strategy assumes that is the exact covariance matrix and builds a portfolio for it. That's like standing on the tip of a needle. If you are nudged a little bit here or there, you have a steep fall, right? So what we should be doing is we should be building portfolios that kind of understands that this covariance matrix is the best estimate of the covariance matrix and it's not God-given. And that's essentially the idea behind my bounded noise portfolio papers that we've essentially used a significant part of in our Darwin strategy, which is to say, hey, whatever we estimate, we're not going to put all our eggs into that basket. We're going to hedge ourselves. We're going to allow ourselves to be wrong in our estimates, and we're going to build portfolios that are not as bad, even if our estimates were a little wrong.
Yeah, agreed. And I certainly think from an economic perspective, we're probably getting into uncharted territory in the sense that with the high tariffs and so on and so forth, this is not a scenario that has occurred too many times in the past. So being able to realize the fact that the assumptions on which your models are constructed may be potentially wrong in the future, I guess is going to be very important.
Right, and I love the statement, Sudhir. There's the statement that says, things that have never happened in the past always happen, right?
Yeah.
And that's very, very critical for us to understand and be humble about, right? So yes, we do. This is like preparing for a test. Just because I don't know the question paper that I will face tomorrow doesn't mean I will not prepare for the test. I will prepare using the past test papers, right? However, to say, hey, my God, tomorrow's test is going to be very different from the past, so I'm not going to prepare is another problem, right? So this is essentially the way we should think of data. The past data is past test papers. We use that to prepare for the future, but to expect the past to exactly repeat itself in the future would be a fool's errand.
Yeah, I would agree. In fact, that's what the next section is also going to talk about, the ego associated with prediction. So let's move on to that slide.
In the last few weeks, we have had quite a few conversations with advisors wanting a prediction of what is going to happen. Some are in the camp of buy the dip, others in the camp of world is ending. I thought this would be a good time to revisit a podcast we did back in November 2024 that talks about the prediction paradox.
Our research looks into something we call the prediction paradox. Every year, market analysts put out their predictions. But here's the kicker: how often do they really get it right? In 2021, 7 analysts made the right call. But in 2022, only 4 nailed it. And guess how many got both years right? 0. That's the paradox. Even the experts with all their tools and experience can't predict the market consistently.
Exactly. The minds can miss the mark. This brings us back to our advisor's question. Is it better to predict or react to the market?
Great segue. Now, let's talk about Darwin. Does it predict or react? Well, Darwin actually does both, but in a specific way. Instead of trying to predict exact returns, like, this stock will go up 10%, Darwin focuses on predicting risk. It asks, what's the likelihood that this asset will face a downturn or crash?
So it's more like, I see some clouds forming. Better have an umbrella ready, rather than predicting the exact minute it will.
Exactly. Darwin predicts when trouble could be ahead, but here's the important part: it also reacts. If the prediction doesn't play out, say the clouds clear and no storm comes, Darwin quickly adjusts based on the real-time market conditions.
So Darwin is saying, here's what I think might happen, but if I'm wrong, I'll switch gears. It's not locked into a single prediction and rigid about it.
Precisely. Darwin's flexibility, predicting when necessary and reacting when things shift, is what makes it effective. It doesn't stick to a forecast no matter what, but instead adapts to the market.
Let's take a quick pause to look at the updated prediction paradox table, now with 2024 and 2025 included. As you can see, not much has changed. Most experts stuck to their original stance. Those who were bullish stayed bullish, and the bears held their ground. The only notable shift came from JP Morgan, which turned bearish going into 2024. Why is there such little movement, even when market conditions clearly change? This is where prediction ego comes in. One of the key emotions we'll explore in the next slide. It's the tendency to stick with your forecast, even when the data suggests it's time to adapt. And that's exactly the kind of emotional interference that can derail portfolios, not just for clients, but for the experts too. This slide dives into what often becomes the biggest risk in investing, not markets, but emotions. The first one is prediction ego. It's when someone makes a call on the market and then refuses to change course even when the evidence says otherwise. It's not just about being wrong, it's about being unwilling to react when you are. Next is the classic tug of war, fear versus greed. Fear shows up when markets are down and portfolios are falling. Clients panic, switch strategies, or even switch advisors. Greed kicks in when markets are flying, but their own portfolio isn't keeping up, and suddenly they want more risk, a different manager, or a new model. This back and forth turns them into what we call butterfly investors, constantly jumping from one idea to the next, never giving any approach the time to work. The third emotion is self-serving bias, that I told you so moment. Clients might claim they saw it coming after the fact or point fingers when a strategy underperforms, even if the decision was aligned with their risk profile. All of these feed into the concept at the bottom, the emotional risk frontier. That's the threshold where rational decision making stops and emotion takes over. For some, it might be a 10% drawdown, for others, just 5%. If a portfolio crosses that line, clients may react in ways that hurt long-term outcomes. The good news? This frontier isn't fixed. It can be raised through awareness, education, and helping clients understand the relationship between risk, returns, and their own emotional triggers. And that's a big part of what we focus on, not just managing money, but managing behavior. This podcast and others are exactly that, help you manage your emotions as advisors and in turn your clients' emotions. With that, we come to the end of the podcast. Hope you liked the content. Kumar, do you want to talk a bit about how the University of Texas at Austin can help with an immersive program around this content for those interested?
So we at UT have a very vibrant executive education program, and we routinely have workshops and immersive sessions. Give it 2 or 3 days. We'll have like-minded individuals, let's say money managers. For example, come to our campus. Coming to campus allows you to think out of the box. Just the physical presence of not being in your work environment allows people to think outside the box. They come in, have fun, network, have a ton of education content to think about, talk to like-minded individuals, exchange notes, exchange intuition, exchange thought process, and more importantly, walk away with UT certification of going through such a curriculum. And our immersive programs have extremely done well, and I'd love to be able to design one for money managers, particularly because that is very, very close to something I love talking about.
Oh, thank you. I appreciate that. In addition to the benefit that they get from being there, you talked about the certification aspect, but then we are also going to talk about behavioral finance, right? When we do the session in terms of how to manage emotions, their own emotions and their client emotions as well. Correct?
Absolutely, and that's the difference between a workshop of this kind versus a course in portfolio optimization, right? So we tend to talk about the real world implications, and specifically real world implications would involve dealing with clients, and we talk about the emotions of greed versus fear, all of that. We'll also share academic content that falls under the intersection of behavioral finance and quantitative finance.
Okay, thanks. Appreciate that, Kumar. Hey, so for the advisors who are interested in something like this, just send me an email and let me know, and we can talk about the timing and everything like that. Thank you.
Before we wrap up, I want to introduce what we believe is a true industry first, a portfolio model built on the best of both worlds, competition and collaboration. We call it the all-star blended model. And I imagine a portfolio where multiple money managers, each with their own style, strategy, and expertise, compete for allocation. So it's like building a championship team where only the top performers stay on the field. For the advisor, it's essentially an easy button. The system automatically reduces allocation to underperforming managers and rewards those delivering consistent risk-adjusted returns. You don't have to manually rebalance or second guess your lineup. Darwin does the coaching for you. The result: a dynamic collaborative portfolio that adapts to market conditions while reducing risk through diversified manager styles. It's a smarter way to build resilience into your portfolio without adding complexity for the advisor. A lot of what we've talked about today, our approach to risk, our models, and even a few of those analogies are also covered in more detail in the book Moneyball Investing, Winning by Not Losing. You can find it on Amazon or just scan the QR code on the screen. Kumar, as always, thank you for doing this with me. Always a pleasure unpacking the world of markets, models, and yes, blindfolded chimps with you. And with that, I think it's time for the academic and the technologist to head back to the bar, hopefully this time with the chimp picking up the tab.